Corporate finance practice problem using Excel. Cash flow calculation. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab in essence being an answer key. Information on the left-hand side, we're going to populate that information into the blue area on the right-hand side. In essence, doing a cash flow type of calculation here, not a full statement of cash flow, basically focusing in on the impact of depreciation. As we move forward, we're thinking about larger kind of decision processes, possibly purchasing of equipment and whatnot. Depreciation then being a big component, oftentimes in longer term type of decisions. They can also distort things or complicate things a bit, because for financial reporting purposes, we see the concept on an accrual basis of applying out the depreciation, but when making the decision-making process, we might be more focused on the cash flow situation. Therefore, that's what we want to do here. We want to look at the depreciation and the impact from financial reporting to the impact that would be on a cash flow basis. Cash flow basis is usually what we're going to be thinking about oftentimes when making large investment decisions into the future. You would think that would be fairly straightforward, but we also have the added wrinkle of the tax impact. The taxes always complicate things more, so we also need to take into consideration the fact that the depreciation could have an impact on the tax return in some way, shape, or form, which has an impact on our cash flow. So then we have to take that into consideration with the cash flow as well. So what we might do in a situation like this, we might say, let's calculate our earnings before our bottom line earnings before we have the interest and tax. Basically our net income here. And you can think about this as kind of like a cash flow statement type of move, where we're then going to say, okay, the depreciation, we're going to fill in the depreciation and then take our tax impact on it. And then we're going to have to remove the depreciation because it's a non-cash flow type of item. So we're going to start off with this 100,000 as if depreciation is not included at this time. Then let's add the depreciation, remembering what depreciation is. It's the allocation of the cost of something that we purchased. When we purchase something, we put it on the books as an asset instead of expensing it because it's a longer term type of thing from an accrual type of basis. And therefore, we apply the cost on an accrual basis, financial accounting basis, over the time period we expect to be benefiting from it. That means that the depreciation itself does not reflect cash flow, but it is something that could have an impact on the income statement and the tax return as well. So we're going to say that this is going to be the 50,000 for the depreciation. I'm going to go to the font group and underline it. And then we're going to say what the earnings before the taxes are. So let's pick up the earnings before taxes. We always have to get to that earnings before taxes so that we can calculate the tax on it. That's going to be the 100,000 minus the 50,000. Then we're going to pick up our tax rate. Now, if we're looking at the income as a whole, we might have to do some kind of calculation to pick up the appropriate tax rate. If we're making this as a calculation on some type of decision that we are then making at the margin, then you might end up using the last tax rate, the last tax bracket that we are in, because that's going to be the thing that's going to happen for the next decision basically on the margin. So we're going to be picking up the tax rate, we'll say 40% here, or we will actually do the calculation. This is going to be the 50,000 times the 40%, 50,000 times the 40%. Then underline it. We're going to go to the font group and underline it. And that's going to give us our earnings after taxes. So the earnings after the taxes are going to be equal to the 50,000 minus the 20,000, giving us the 30,000 remaining. And then, so this is where we're going to be earnings after taxes. So remember, we started off here assuming that the depreciation and taxes not included. Then we added the depreciation to get to the earnings before the taxes, assuming that depreciation is something that will be taxable. Also note, when you're thinking about taxable depreciation, you're thinking about the tax impact. The depreciation might be something different than book depreciation as well. So we're trying to think about what the tax calculation will be on it. And then the taxes will be calculated, earnings after taxes there, and then we can take out the depreciation. So I'm going to pick up the depreciation again and say this is going to be the 50,000. And so now this 30,000 now includes depreciation, which is not something that is a cash flow item. So we do not want to include it, but we had to include it in order to estimate what our taxes would be. And now that we have calculated the taxes, we can take the depreciation back out by, in essence, adding it. So we're at the 30,000 plus that 50,000 that we deducted, that now we're going to basically remove or reverse. So in other words, we put the 50,000 in up top, and just to calculate the taxes, now we're taking it back out because it is something deductible on an accrual basis, or hopefully for taxes, we need it to get our tax impact, but then to get back to a cash flow basis, we got to remove it back out again. And that's going to be our cash flow. So that's going to be the process. This will be useful whenever you're looking at these long-term projects and you're trying to get like a calculation of, you know, what's going to be the payback period, or, you know, what type of a decision-making process for it. You got to think about the depreciation and the impact of the depreciation on a cash flow basis and accrual basis, and then the impact of the taxes. The taxes always being something that complicates things quite a bit. Let's do it again down here. We're going to say the earnings before depreciation and taxes. So we're assuming this being the earnings before we have included the depreciation. Then we'll put in the depreciation so that we can calculate the tax at the 35%. Once we have the tax included, then we'll remove the depreciation to get back to basically a cash flow calculation for it. So I'm going to say earnings before depreciation. We're going to be picking up the 40,000. And then we're going to be saying that the depreciation is going to be equal to the 41,000. Underlining that, font, group, and underline. That's going to give us our earning before taxes. Earning before taxes equal to the 140,000 minus the 41,000, or the 99,000. Then we'll calculate the taxes now that depreciation has been included, which is going to be the 99,000 times the rate, which we're saying is the 35%. And that's going to be the 34,650. Underlining that, going to the font group and underline. That's going to give us our earnings after taxes. So earnings after taxes is going to be equal to 99 minus the taxes is going to give us the 64,350. Then we're going to take the depreciation back out. We had to include it in order to calculate the taxes, because taxes complicate things. Taxes complicating things all the time. So, but now we'll take it back out. Font group, underline. Just makes it more interesting. It's not frustrating, just interesting. So we're then going to sum this up, and that'll give us the 64,350 plus the 41,000 for the 105,350.